Welcome back to the Daily Brief Explainer. Today, we're connecting the dots between global geopolitical tensions and their very real, direct impact on the financial markets. We're looking way past the daily headlines today to untangle a massive web of global economics and, really, examine the deep structural shifts that are happening right beneath our feet. Let's kick things off with a massive question that the Wall Street Journal just threw out there regarding heavily sanctioned nations. Are these financial blockades actually working? I mean, for years, economic sanctions have been the absolute go-to tool for applying pressure without, direct military intervention. But looking at the global landscape today, especially when we're talking about Russia, North Korea, and Iran, we really have to ask if this strategy is achieving its intended results or if it's accidentally setting off a chain reaction that kind of changes everything.
All right, so here's our game plan for today. We'll start with a sanctions reality check, move over to the Middle East chessboard, map out the new financial architecture, and wrap up with the strategic asset of the hour, gold. Let's dive right in. Part 1, the sanctions reality check.
Look, if you're going to judge whether a policy is a massive failure or a success, you've got to know where the finish line actually is, right? If you think the ultimate goal of U.S. sanctions on a country like Iran is total regime collapse, well, you'd probably say they've completely failed. You simply cannot force total submission through economics alone, especially not when dealing with a government that maintains such strict control over its domestic media and its population. But the realistic goal, it's always been a bit different. It's about delaying a nuclear program and driving up the cost of that program immensely. It's about changing the math for these nations. And when you analyze the sanctions through that specific lens, you start to see a very deliberate, high-stakes strategy playing out beneath the surface. Moving right along to part 2, the Middle East chessboard. You know the old saying, when one route gets blocked, water just finds another way to flow. To survive the U.S. squeezing their economy, Iran has basically engineered a masterclass in economic survival. They project influence through massive geographic chokepoints, like the Strait of Hormuz, where a huge chunk of the world's daily oil supply literally has to pass through. They're also financing regional proxies to maintain leverage and project power way beyond their own borders. But here is the absolutely crucial maneuver, establishing alternative financial routes. They still have to sell their oil, their hydrocarbons, their fertilizers to survive. When you get locked out of the primary global financial system, you don't just stop trading. You are forced to find a completely new system just to keep your economy breathing.
So what's the actual outcome of all this maneuvering? Honestly, it's fascinating. Both sides have basically slammed into a brick wall. The U.S. has successfully delayed the nuclear programs for sure, but at a massive marginal cost, both economically and diplomatically. Enforcing these blockades takes a ton of resources. And at the exact same time, Iranian leadership is signaling a profound need to relieve economic pressure and rebuild at home. They're actively pivoting from this singular focus on military development back to basic domestic economic survival. The cost-benefit analysis for both sides is just flashing red right now, telling us the current path is rapidly becoming unsustainable.
All right, part 3, the new financial architecture. And this right here is the real plot twist of the whole explainer. Because these sanctions, they are unintentionally turbocharging a massive transformation in the global monetary system. Since the post-war era, global finance has completely relied on U.S. dollar hegemony and institutions like the IMF. The petrodollar has literally been the undisputed king. But precisely because of this heavy use of sanctions, we're now witnessing the birth of a totally parallel, independent financial network. Sanctioned nations still have to clear trades, right? So powers like China and Russia are stepping in to provide the plumbing, often using digital payment systems that exist completely outside the traditional U.S.-dominated banking sphere. It is a seismic shift away from the legacy system. This creates this transactional loop that actively dilutes U.S. economic pressure. It's a perfect synergy of needs. China steps in and acts as a massive release valve. They secure vast amounts of heavily discounted energy from these sanctioned nations, and in return, they enforce the adoption of their own currency, the yuan. For the sanctioned nations, it's a vital financial lifeline. It's a cushion that absorbs the shock of those Western blockades. They get to keep their economies afloat, while China gets to steadily internationalize its currency and lock down cheap energy for its massive manufacturing base. Win-win for them.
And look, the rest of the world is definitely taking notes. As the U.S. flexes its sanction muscle, even countries that aren't sanctioned right now are looking at this and thinking they are heavily incentivized to join or at least support these alternative systems to protect their own future sovereignty.
The sheer volume of sanctions has essentially provided the necessary push for emerging markets to diversify away from a unipolar financial system. Global economic power isn't just concentrated in one hub anymore, it is actively distributing into this highly complex, multipolar web where bilateral trade agreements and non-dollar settlements are rapidly becoming the new normal.
Which brings us to our final section, number 4, the strategic asset, gold. Okay, so whenever the global macro plumbing gets completely rewired, specific assets step right into the spotlight. I want you to focus on this number right here, 19. This isn't just some random statistic, it is a massive, flashing indicator of where global central banks believe the world is heading. 19 represents the consecutive months that China has aggressively, heavily accumulated gold. That is 19 straight months of gold accumulation by China. We literally haven't seen a streak like this since 2015. So why is this happening? Central banks and emerging markets are effectively weaponizing their reserves. They're looking at the sanctions landscape and realizing that the ultimate defense against being locked out of the US dollar system is to just hold a neutral, universally recognized asset. They are buying gold to assert their independence and shield their economies from potential future geopolitical fallout, because they know that physical gold, held in their own vaults, carries zero counterparty risk. And if you want to see just how committed they are to this strategy, look at this. Even despite recent price drops in the gold market, drops that were actually triggered by sales from Gulf states, China didn't even flinch. Actually, scratch that, they capitalized on the dip. They purchased 8 tons of gold in April and then stepped it right up to 10 tons in May. They aren't trying to time some quick day trade here. They are aggressively buying the dip for long-term structural reasons. They view gold as the fundamental base money for this newly forming global financial architecture.
So let's pull all these threads together. Here is the ultimate bull case for gold right now. Geopolitical tensions might cool down temporarily. Maybe we get a de-escalation in the Middle East or a pause in new sanctions, but the underlying structural transition is already in motion. That train has left the station. The ongoing economic friction between the US and China, the sheer desire for central bank independence, and the literal creation of a new global monetary architecture make the long-term trend for gold clearly bullish. It is no longer just a hedge against inflation, it is the ultimate geopolitical insurance policy. When trust in fiat currencies and traditional banking rails starts to fracture, the historical default has always been gold. We are living through a historic, real-time transition in how the world's money actually works. And that leaves us with one absolutely critical question for your own strategy. As this new multipolar monetary system gets defined, how are you positioning your portfolio? Are you relying entirely on the old rules of the game, or are you adapting to the new reality? Thanks so much for joining me for this explainer. Keep learning, keep analyzing, and I'll see you next time.